All right, so let's get right into it. You're bullish on uranium. The whole story makes sense. The fundamentals look solid. But there's one big problem. How do you actually get exposure? It's not as simple as just buying one stock. So we're going to break down the main options. And that's really the big question we're tackling here. Because, depending on your appetite for risk and exactly what part of the thesis you believe in most, the right answer for you could be completely different from someone else's. Thankfully, Sprott kind of lays it out for us with a three-tiered approach, and that's what we're going to dive into. The best way to think about these three, the physical trust, the miners ETF, and the junior miners ETF, is like a risk ladder. Seriously, down at the bottom, you've got the most direct, pure play exposure to the metal itself. As you climb up the rungs, you start adding on layers of business risk, operational risk, but also the potential for much greater returns. So let's start at the foundation. Okay, Tier 1. This is all about the commodity. It is the purest way to bet on the price of uranium going up, period. You're taking all the messiness of actually running a mining business completely out of the equation. So what is this trust exactly? Well, the concept is actually incredibly simple. Sprott takes investor money, goes out and buys actual drums of U3O8, yellow cake, and then just stores them in a secure facility. Your shares are basically a claim on that physical uranium sitting in a warehouse. It's the most direct way to own the stuff without, having it in your garage. And right here, you see the core trade-off. The advantage is massive. You have zero mining risk. A mine could flood, workers could go on strike, a country could have a coup, and it won't directly affect your asset. You're just betting on the price. But the disadvantage is all about the structure. For U.S. investors, it's considered a passive foreign investment company, a PFIC, which, trust me, means your tax situation gets a lot more complicated. And because it's a closed-end fund, well, this happens. The market price for shares of the trust can, and often does, drift away from the actual net asset value of the uranium it holds. When everyone's excited, it might trade at a premium. When sentiment is bad, it can trade at a discount. So you have to remember, you're not just betting on the price of uranium. You're also betting on the market's mood toward the fund itself. Okay, let's climb up to the next rung on that ladder. This is where we stop just owning the metal and start owning the companies that actually dig it out of the ground. So URNM is an ETF that bundles together the biggest names in the game, the established producers, your Kamekos of the world. But here's the really clever part. It also holds a decent chunk of the physical trust we just talked about. This gives you this really nice balanced vehicle with exposure to both the commodity itself and the profitable businesses that are mining it. The benefit here is pretty clear. It's balance. You get the stability, the cash flows, even potential dividends from these major companies, and it's all sort of buffered by that pure commodity holding. So, what's the catch? Well, these are giant corporations, right? They aren't some startup that's going to multiply its value 10 times overnight, even in a crazy bull market. Their growth potential is just naturally capped by their massive size. For that kind of explosive move, you have to keep climbing. And that brings us to the top, the high-risk, high-reward tier. This is the purely speculative play, designed for investors who really want to maximize their potential upside and are, let's be honest, okay with some serious volatility. J is all about the juniors. And you have to understand, these are often small, scrappy companies that aren't even producing any uranium yet. They're out there exploring for new deposits, or they're in the middle of that long, super expensive process of developing a mine. Most of them have little to no revenue, and that fact introduces a completely different dynamic, which can be summed up in just one word. Leverage. That's it. This one word is the entire reason you would even consider investing in junior miners. It is the engine that can create absolutely mind-blowing returns. So how does this actually work? Okay, imagine a small company has a uranium deposit, but it's only profitable to mine it if the price is above, say, $90 a pound. If the spot price is $85, that deposit is basically worthless, and so is their stock. But what happens if the uranium price ticks up to 100? All of a sudden, their project isn't just viable, it's a potential gold mine. That small jump in the commodity price can cause a huge, exponential re-rating of the company's stock value. That right there is leverage in action. And this, of course, brings us to the big trade-off. The advantage is that incredible leverage to the uranium price. But the disadvantage is that leverage is a two-way street. These stocks can and do crash violently. And because they don't have revenue coming in, they often have to raise money by issuing new shares, which dilutes your ownership stake. It is the absolute definition of high risk, high reward. Okay, We've gone through all three tiers, the pure metal, the big miners, and the small explorers. Now let's pull this all together into a simple framework to help you figure out which one, if any of them, might be right for you. First, let's just have a quick look at the costs. As you can see, there's not a huge difference. They're all in the same ballpark, but they do tick up just a little bit as you move up the risk ladder, from the simplicity of the trust to the more actively managed ETFs. This table really lays it all out nicely. You've got the physical trust, your pure play on the metal, where the main risk is just price volatility. Then there's Uranium, the balanced approach to the whole industry, but now you're taking on the operational risks of the big miners. And finally, URNJ, the aggressive growth play, where the risk is that they never find or develop anything, but the reward is that powerful leverage. So really, you just have to ask yourself, which one of these sounds like me? Are you the commodity purist who just wants to own the metal and sleep at night without worrying about a specific company? Are you the balanced strategist who wants a diversified, kind of set it and forget it bet on the whole theme? Or are you the growth speculator, willing to stomach that wild volatility for a shot at truly spectacular leveraged returns? Ultimately, the choice comes right back down to how you, personally, want to express your belief in this uranium market. There's no single right answer here. There's no magic bullet. There's only the vehicle that best matches your own research, your own stomach for risk, and your own investment thesis. So the real question is, which one is it?